Hey, everybody. Welcome to another episode of the Dan Habib Show. I'm your host, Dan Habib. Listen, if you've been following these videos, this is a new channel. If you're getting value out of these videos, please support it, like, and subscribe below. Also, a couple quick reminders. If you're in the mortgage or real estate space, make sure to check us out, mbshighway.com. You can sign up for a 2-week free trial, but it is the best insights in the mortgage and real estate industry every single day. Videos like this that I'm doing for free, you will be able to get every single morning when the news is breaking. Also, if you're interested in learning more about the crypto space or you want to have the best intel to help you make educated investing decisions, make sure to check us out, cryptocharts.com. You can also sign up for a trial, or if you choose to sign up, if you use the code Habib, you will get a 40% discount. All right, listen, let's jump right into it. As I'm recording this here, it is Friday, September 30th, and boy, am I glad to see September go away, because it has been a volatile September. It's been a bloodbath in the stock markets. You see the Dow, S&P, NASDAQ challenging their lows and some setting new lows from earlier in the year. You see interest rates shooting up to above 6.5% now, in some cases just below 7%. So it has been volatile. So like the song says, wake me up when September ends, from Green Day, right? Well, as we head into October, we did get some important news here today, as well as yesterday. So we got some new data from the second reading, the final reading on Q2 GDP. And this came out the same as the second or preliminary reading at negative 0.6%. So this confirms exactly what we've been thinking, that, hey, we are in fact seeing 2 consecutive quarters of negative GDP. Q1 was negative 1.6%, Q2, now the final reading showing negative 0.6%. That is 2 consecutive quarters, team. And by every other definition out there, back to your school days in macroeconomics, that typically means, and as far as Wall Street is concerned, means that we are in a recession. However, the referee, the NBER, the National Bureau of Economic Research, they are the ones that have to officially call a recession. Now, they're never calling that we're currently in a recession. It's always, hey, 6 months ago we were in a recession. But by all standards, this should be considered a recession. In fact, if you go back to 1947, we have never seen 2 consecutive quarters of negative GDP that was not classified an official recession. However, the NBER, the White House, the administration, even the Fed, trying to talk their book and basically say, well, it doesn't mean that we're officially in a recession because the guidelines or the goalposts have been changed. Now the NBER says we need to see economic contraction that has a certain degree of depth, duration, and diffusion. In any case, I believe that we are either currently in, or at least in a very short time period, headed for a recession. What does that mean for us in the markets? Well, typically those are not good things for the equity markets or for the risk-on markets. On an average recession, you see a 35% decline. Now, when that starts to when that ends, or to the low point, is typically where you get that 35 or 30% decline. We don't know when this is going to be classified as beginning. We know we've seen prices come down quite a bit already. However, I would not be surprised to see the stock market come down and probably hit somewhere in a 3,000 to 3,200 range as measured by the S&P 500. There's even a chance it goes a little bit lower, but that's just my opinion. And how is that going to correlate to risk-on assets like cryptocurrencies? Well, you'll probably see them at least come down and retest their lows around 17,500 when we're talking about Bitcoin. But I think there's a chance, depending on that correlation there, that you could see an even better buying opportunity. So make sure you have some money on the side, you have some dry powder to take advantage of some of these multi-generational buying opportunities that will present themselves, in my opinion, in the next 6 months. Now, we also got the Fed's favorite measure of inflation, PCE, or personal consumption expenditures. Now, there's 2 real main inflation reports. The Consumer Price Index, which is the one that really most people in Wall Street, and I think the markets, like to pay more close attention to, because it puts a much greater weighting on out-of-pocket medical expenses as opposed to being weighed down by Medicare and Medicaid like you have in the PCE report. And also, about a third of it is putting a roof over your head, right? Whether it's rental costs or housing costs, and each one of them has their faults. But PCE only has about half of that weighting for the cost to put a roof over your head, which is people's biggest expense. So as a result of that, you are seeing the PCE run much lower than the CPI. The last CPI report we saw, the headline number was 8.3%. The PCE that just came out this morning, it's at 6.2%, which did fall from 6.4%. Now, if you look at the month over month reading, it was up 0.3%, a little hotter than the 1/10 expected. Now, when you take a look at the core reading, and this is really the big one, team, the core reading strips out the volatile food and energy prices. The reason the Fed likes to look at the core reading is because they are trying to impact inflation with their monetary policy. And they feel they can't impact food and energy prices, which does make sense because if you think about it, what if there's some geopolitical tensions that's causing oil prices to be higher or lower? What if there's some situations like we're seeing in Ukraine that's causing food prices to be higher? Or maybe there's a drought, different things of that nature. So the Fed strips out food and energy. They look at the core reading of inflation because they believe that's what they can impact with their monetary policy decisions that they're making, aka hiking rates, which we know they're doing currently. Now, the core reading, it went up by 0.6% last month alone, which was higher than expectations. And when you look at where that number is now, it is at 4.9%. So that went up. And this is something that the Fed does not want to see because remember, the Fed wants to see this core reading not at 4.9, but closer to 2%. That is their target. And that is what they are talking about when they say that they are going to be hiking rates until we see inflation come down to meet their 2% target. They're talking about the core PCE reading. So that's something you're going to be wanting to watch closely. I don't think it's going to have to get to 2%, but based on what's happening in the market, if we do see, which I think will happen, inflation start to abate by the end of the year, beginning of next year, if you see it getting at least closer to 2%, maybe with low threes, high twos, I think that could be an area where the Fed might take the foot off the gas pedal a bit. Of course, things can change if hell goes into a handbasket with the economy and the equity markets. We know that their unspoken third mandate is asset prices. So they may be forced to take their foot off the gas even sooner than that, but we will have to see. Now, listen, after the volatile week we saw this week, we hope next week is a little bit calmer, but it's a big week. We have jobs week. That means the ADP employment report is going to come out Wednesday morning, 8:15 a.m. Eastern time. As of now, market is expecting around 200,000 job creations. This will be for the month of September. And then on Friday, probably the biggest report we receive each month, we have the BLS, the Bureau of Labor Statistics jobs report, which is going to be coming out 8:30 a.m. Friday morning. This is the biggest potential market mover. Right now, markets are looking for 250,000 job creations and for the unemployment rate to remain at 3.7%. Make sure to tune in. And guys, please support the channel, like and subscribe below. We'll talk to you next week.